Welcome back to the Daily Crypto Deep Dive. Today we're going into one of the biggest questions in the entire digital asset space. Not which coin is pumping today, not which chain is trending on Twitter, but which cryptocurrencies will genuinely still exist in 2030. And not exist in name only, but actually matter, actually retain liquidity, actually keep developers, and actually remain relevant enough that investors still want to hold them. It's the topic nobody really wants to confront because everyone wants to believe their favorite coin is immortal. But history tells us something very different. Since 2017, more than 24,000 tokens have disappeared, been abandoned, rugged, or simply faded into irrelevance. Even coins that were top 10 giants have fallen 90% in liquidity and disappeared from exchange listings. So today, we're doing the long game, the real game, the survival game. We're going chain by chain, coin by coin, looking at what gives a project true longevity and what could genuinely threaten even the biggest names in the space. And yes, we are sticking our neck out because pretending every coin survives is lazy analysis. Some will thrive, some will limp on, and some will quietly die. It's the reality of an early-stage technological revolution. There will be winners, but there will absolutely be casualties. And if you hold these assets personally, if they form part of your future, part of your retirement plan, part of your long-term strategy, you need to know which ones are structured to last and which ones are built on foundations that are shakier than anyone wants to admit. Before we get into it, make sure you're following the podcast on Spotify and leave a 5-star rating if you haven't already. It genuinely helps the show get pushed in front of more people, especially during weeks where the markets are shaky and people are searching for answers, and feel free to drop your thoughts in the comments. Tell me which coins you think will make it to 2030. You'd be surprised how divided analysts are on this topic. Now let's break this down. Not like a price update, not like a hype piece, but as a long-form survival analysis. We start with Ethereum because whatever people feel about it, it still sets the tone for all of smart contract crypto. Ethereum is the closest thing crypto has to an established blue chip, but even here, analysts disagree about how durable its current dominance really is. On the survival side, you've got overwhelming developer activity, the largest institutional support base, the biggest smart contract ecosystem, and a huge advantage in talent and tooling. This is the reason why Bank of America, VanEck, and Fidelity all argue Ethereum is the most secure long-term bet outside Bitcoin. But there is another side of the argument that rarely gets spoken aloud. Ethereum's biggest risk comes from fragmentation inside its own ecosystem. Roll-ups are powerful, but they also create a world where liquidity spreads out across dozens of chains instead of one strong base. Some analysts argue this could dilute the value of ETH over time, weakening the asset even as the tech succeeds. There's also governance risk, politics inside the ecosystem, delays in upgrades, and increasing narratives that Ethereum is becoming dependent on institutional approval, nothing fatal. But not invincible either. Now let's talk about Solana, because this is where we genuinely stick our neck out. Solana has had one of the biggest comebacks in crypto history, from total collapse post-FTX to becoming the home of consumer adoption, meme coin culture, mobile crypto, and some of the fastest growing developer numbers anywhere. If Ethereum is the institutional chain, Solana right now is the retail, experimental, explosive chain for survival. It's got speed, scalability, and momentum on its side. But it also has real existential risks. Solana's biggest threat is still centralization of hardware and validation. Most chains have some form of centralization, but Solana's requirements are high enough that critics argue it creates a long-term bottleneck. Then there's the risk of outages returning, even if they're far less common now. But the real threat comes from the fact that Solana's strengths rely heavily on adoption continuing to grow. And if liquidity ever dries up during a long bear market, the chain could face structural stress that Ethereum simply wouldn't. Nothing here screams collapse, but it is honest analysis. Solana has earned its place, but it isn't past all the dangers. Now XRP, and this one we cover very carefully. XRP absolutely has survival potential because it sits in a niche that hasn't been fully explored by any other major project. It has regulatory milestones behind it, court clarity others don't have, and a long-term strategy focused on banking, liquidity, FX, remittances, and institutional settlement. But the threat for XRP has always been adoption speed. Analysts like Matt Hamilton and even neutral commentators at Bernstein agree that the tech works. The big question is whether global institutions move fast enough for XRP to remain a frontrunner by 2030. The good news is that stablecoins have validated the exact sector XRP has targeted for a decade. The threat is that stablecoins also create an easy competitor. And if central banks begin rolling out wholesale CBDCs, the competitive landscape shifts again. So survival potential? Absolutely. Guaranteed? No. But XRP is one of the few coins that could still be relevant in a decade if global institutions follow the adoption curve analysts expect. Before we move to the next coins, we are going to take a quick break. Stay with us. We will be right back after a word from our sponsors.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
Next, Cardano. And this one requires honesty. Cardano has one of the strongest treasuries in crypto, and no matter what anyone thinks, it is not going away anytime soon. But it faces the same challenge it's always had: the pace of development. Analysts at Messari and even some inside the Cardano ecosystem argue that if Cardano doesn't accelerate visible, consumer-facing progress, it risks losing relevance even if the tech is academically sound. The good news? Cardano is built to survive. It just has to prove it can keep retail interest alive. Survival odds are decent. Growth odds are the real debate. Now Polkadot, a fascinating, complex project with one of the most ambitious long-term visions. Cross-chain governance, shared security, and the ability to update without forks. But it also has extreme competition. The biggest threat to Polkadot isn't failure, it's irrelevance. Analysts point out that Polkadot's developer numbers remain respectable, but retail interest has declined sharply. If this trend continues, Polkadot may survive, but fade into a smaller, specialized ecosystem, rather than a major L1. The survival argument is strong, the relevance argument is weaker. Avalanche is next, and here the split is crystal clear. Avalanche is gaining enterprise traction and subnets genuinely work. But analysts like Ryan Watkins have warned that Avalanche could struggle if Ethereum L2s continue to dominate institutional adoption. The survival risks here aren't structural, they're competitive. Avalanche needs large-scale adoption to justify its subnet's narrative. If it gets that, it could thrive. If not, it risks being overtaken. Chainlink is one of the few coins analysts almost universally agree will exist in 2030 because it solves a problem every blockchain needs: external data. But even here, there are risks. Competitors like Pyth and Redstone are growing, and some argue that Chainlink's fee model must evolve to match decentralization expectations. Still, Chainlink has arguably one of the strongest survival profiles of any non-L1 crypto asset. Now we get into a broader truth. The biggest threats to these ecosystems often aren't the flaws inside them. They're the global forces outside them. Regulation, liquidity cycles, developer flight during long bear markets, and consolidation. The history of technology repeats itself. Dozens of strong companies collapse because a handful of giants attract all the users, talent, and capital. This isn't FUD, it's structural reality. Analysts at Electric Capital, Coinbase Institutional, Grayscale, and Pantera have all warned that we are likely heading toward a world where between 5 and 10 strong L1 ecosystems dominate everything. Everyone else either becomes niche or disappears quietly. So let's examine something crypto almost never talks about. The truth that even some big chains could realistically die. What actually kills a major coin? It's not price going down. Price is irrelevant to survival. What kills a chain is losing developers. Losing liquidity, losing incentives, losing relevance, losing narrative, and most importantly, losing users. When there's nobody left to build, nobody left to govern, and nobody left to care, even the biggest ecosystems crumble. This is where ablation comes in. The phenomenon where smaller ecosystems get absorbed or drained by larger, more powerful ecosystems. And here's the twist. Ablation has two faces. Sometimes it strengthens the overall market by consolidating talent and innovation into the ecosystems that actually work. But it also accelerates the death of mid-tier chains. Analysts at Coinbase have hinted several times that between now and 2030, we could see a major L1 simply run out of steam. Not rugged, not hacked, just abandoned slowly. This is where naming coins directly becomes uncomfortable. But let's do it. Avalanche, Polkadot, Algorand, Cosmos Hub, Near, and even Cardano to a degree face the same structural threat. Ethereum and Solana are consuming developer talent at a speed nobody expected. This is not an opinion. The Electric Capital Developer Report shows it clearly. Chains that cannot keep developers do not survive. And even if they don't outright die, they fade to a point where their token becomes irrelevant compared to the growth of stronger ecosystems. But it works the other way too. Ethereum faces the risk that rollups become too fragmented. Solana faces the risk of over-centralization and throughput expectations. XRP faces the risk of institutional adoption being slower than predicted. Cardano faces the risk of slow consumer-facing development. Polkadot faces the risk of branding weakness and declining retail interest. Avalanche faces the risk of L2 competition. Chainlink faces the risk of competitor oracles rising. Every major coin has a genuine survival threat. Real, structural, non-emotional. Now here's the part your audience will really care about. The conservative, analyst-supported probability map. Not definitive predictions, just survival odds based on fundamentals. Ethereum has the highest survival profile, likely 90% plus. Solana somewhere in the 70 to 80% range. XRP around 60 to 70% depending on institutional adoption. Cardano perhaps 60% with high uncertainty. Polkadot around 50% depending on relevance. Avalanche around 50% depending on enterprise traction. Chainlink around 85 to 90% because infrastructure coins tend to survive better than layer 1s. And here's the truth people don't want to hear. Survival isn't binary. A chain can survive but fade. A coin can exist but have no liquidity. A project can function but be irrelevant. The winners of 2030 won't just be the chains that survive. They'll be the chains that stay relevant. So where does that leave us? The balanced, honest takeaway is that the crypto market will consolidate. Not collapse, consolidate. Some major coins will lose relevance, some will merge, some will shrink, some will thrive. And the ones you hold should be held for reasons beyond short-term hype. Developer activity, treasury strength, product market fit, regulatory resilience, long-term adoption curves. These are what determine survival, not Twitter narratives or one-week price moves. Over the next decade, analysts believe crypto will function more like the early internet. Dozens of protocols existed, but only a handful mattered. The rest weren't dead, they were just irrelevant. That is the future altcoins face. Not a graveyard, but obscurity. And for investors, the goal is simple. Position yourself in ecosystems with the strongest structural advantages, clearest narratives, and deepest developer communities. Those are the coins that survive the decade. And that's where we wrap this deep dive. A sober, conservative, evidence-based survival blueprint. Not hype, not fear, just the long-view picture of what might actually stand the test of time. If you enjoyed this episode or learned something new, make sure you follow the show on Spotify and leave a 5-star rating. It genuinely helps, especially during long-term episodes like this where we go deep on future-focused analysis. Drop your thoughts below. Tell me which coins you think survive and why. And as always, stay safe, stay informed, and we'll see you at the top.